So now let's talk about onerous contracts. So onerous contracts is the contract that is not profitable, right? Not all contracts is profitable. Remember, the risks is on the contractor, right? In the beginning, you bid for a price, and that price is profitable. But guess what? Building materials tripled, the price tripled. So now, when at the end of the second year, realize, guess what? I'm going to lose money. So at this point, you know that this is not a unprofitable contract. It's called onerous contract. Okay. As soon as you realize this is the contract turned into an onerous contract, you have to recognize the full amount of loss. Okay. So this is about the prudence, conservative principles under the IFRS conceptual framework. So they would rather to be conservative with bad news. Okay. As soon as there's bad news, they try to get this bad news right away, right, to the investors, users. So you recognize all this loss, right away. Okay. The idea is IFRS doesn't like financial statement revenues to be overstated. This is onerous contract at the end of the day, and you still recognize the revenue this year? Come on, that's a lie, right? That's a liar. You are trying to make current year's income statement looks nice, even though at the end of the day, this contract is turned out to be not profitable, right? So you see the rationale behind this, okay, onerous contract. Okay, so here is one example, okay? So now we have 3 years, okay? We have 3 years. The actual cost each year, 24, 80, 12. Additional cost to complete, estimated at the end of each year, 72, 26, 0. Total estimate cost at the end of each year. Okay, let's use the same graph, okay? Now, pay attention to this arrow. We are at the end of 2018, okay? We are at the end of 2018. So I want to know, is my contract profitable? Okay, is it profitable? My contract is profitable? Yes. At the end of 2018, my total estimated cost is 96 million. And the fixed price is 120 million. So my cost is under my price. So it's profitable. Okay. Now we are another year past. At the end of 2019, okay, we have new information. Okay. So what is the total expected cost? So the actual cost 24.80 for the first 2 years, and the estimate for the third year is 26. So my total is 130. So 24 plus 80 plus 26. So that's $130 million. That's more than 120 price. At this point, I know this is an onerous contract. Okay. And what's the amount of loss expected? The difference is $10 million. So this project, I'm going to lose $10 million. I want to make sure up to this point, the total amount of revenue I recognize that should be negative $10 million. Okay. The expected future loss has to be recognized. Okay, has to be recognized at the end of 2019, so that you recognize the whole amount of loss. Okay, $10 million loss. And now we are at the end of 2020. Okay, so now I have new information. The total amount of cost is 24 plus 80 plus 12. So it's 116 million. It's less than 120 million. So now I see it's actually profitable contract, I even make $4 million. Okay, so then you have to reverse the 2019's entry, okay, for the future loss recognition, because now you know actually there's no loss in 2020. So whatever the journal entry recognizing future loss in 2019 has to be reversed. Okay, because you have new information, you always go with new information. Okay, does this make sense? Do you understand what is onerous contract? We are going to do one example, but before that, I want to give you a kind of conceptual ideas. What do we mean by onerous contract? Anyone?
I know in jobs that I've had before, like repair projects, sometimes end up being, I guess, more work than they're worth because things are worse than they were quoted, and we couldn't like change what we're going to bill. Like it wouldn't have been cost plus. So that's, I mean, it's similar to a construction thing, right? But basically just like it's going to cost more to fix it than we thought in the first place, and we're already locked into what we're billing.
Okay. Oh, that's interesting. So you have a job experience with such similar contracts.
Yeah, because I worked at a place that would always like lowball on quotes and then find out halfway through that lowball too much.
Yeah. That's the thing, right? You really want to get a job, right? You pay low, and then you run to this kind of scenarios. Okay, so let's work on one example. Okay, let's work on this example. So we have, okay, what happened here? Let's see. Okay, we still have 10 slides, okay? But don't worry, I will take my time. I don't want to rush through these things. Okay, so I'm gonna walk through this just to see how we're gonna deal with this, okay? So in 2018, okay, the actual cost is 24, okay? The cumulative cost incurred to date is 24 because this is the first year, okay? And additional cost to complete is 72. The total estimate is 96. Then I calculate the percentage completion using cost to cost approach. So that's 25%. Okay, so that's 24 divided by 96. So cumulative revenue recognized to date, so I'm gonna use 25 times 120. So I need to recognize up to this point $30 revenue. This is the first year, no revenue is recognized previously. So for current year, I need to recognize 30. Cost of sales, that equals to the actual cost, 24. The gross profit is 6. At this point, it's a profitable contract. So I don't have to consider unexpected future loss, right? Because at this point, I think the contract is profitable, okay? So your gross profit for current year is 6. Do we have any question for 2018? If it's clear, say clear, so then I can move on, okay? Otherwise, I'm always concerned you need time.
Clear.
Yeah, it's clear.
Okay, thank you. And definitely makes things easier. Okay, let's move on to 2019, okay? So the actual cost is 80. So the cumulative cost is 104, okay? Because cumulative, right? So in the first year, 24. In the second year is 80. So together, the accumulation is 104. And additional cost to complete, 26, that's your estimation. So the total expected cost is 130, okay? Boy, at this time you know, okay, 130 is more than 120. This is the onerous contract, okay? So now let's calculate percentage of completion. What's my percentage of completion? Can anyone tell me how to calculate it?
So 80 over 130?
80 over
80%.
130.
80%. I heard 80%.
Yes.
Okay, so how did you calculate 80%?
So I added the actual costs for each year for 2018 and 2019, and I divided it by 130, the total estimated cost of contract.
Okay, yeah. So cumulative cost incurred to date, 104, divided by total expected cost. So 104 divided by 130, that's 80%, okay? So up to this point, I should recognize 80% of this revenue, which is 96. And in the first year, 2018, I already recognized the 30. So for 2019, I only need to recognize 66. Okay, and the cost of sales for current year, that's equals to actual cost, that's 80. My gross loss is 14. My gross loss is 14. 66 minus 80. Okay, that's 14. Remember, at this time, I know this is the onerous contract. Okay, so I have to recognize the future loss, right? So right now, I'm only recognizing 80% of the loss, right? 80%. There's another 20% that will be completed in 2020. I have to recognize that as a loss, right? So the loss for the project is 10 million. The total cost is 130. The price is 120. So the total loss for the project is 10 million. What about 20%? The loss is, so for 100% is 10 million, right? The loss. What about 20%?
2 million.
2 million, right? 2 million. So you have to recognize the expected loss in 2020, right? 2 million, right? So in total, your loss for 2019 should be 16. Okay, so up to this point, what's the total amount of income or loss has been recognized? The first year you recognize 6, and second year you recognize a loss 16. The net is a loss of 10 million. That's perfect, right? That's the number we want to recognize. Remember, at this point you realize, boy, for this whole project, it's 130 cost, 10 million is beyond the price, right? So up to this point, my total recognition should be $10 million loss. And here it is, 6 plus negative 16. That's $10 million loss. Does this make sense?
Yes.
Awesome. I'm glad we are going so smooth this time. Okay, that's really helpful. Okay, let's go to 2020. 2020, the actual cost is 12. Cumulative cost to date is 116. So 24, 80 plus 12. So these three actual numbers is the cumulative cost together is 116. What's the additional cost to complete? 0? This is last year, right? 0. The total estimated cost of contract, 116. It's 100% completed, right? In total, you should recognize 120. How much you have recognized so far? You recognized 96 already. First year 30, second year 66. And now in 2020, you're going to recognize the difference, 24. Okay. And the cost of sales is the actual cost, 12. So now your gross profit is 12. Okay. Remember, at this time point, you realize this is actually a profitable contract, right? So what are you gonna do with this $2 million recognition in the prior year? This entry, this expected loss has to be reversed because there's no loss in 2020. So you're gonna add the $2 million back. So you recognize a $14 million gross profit. So in total, 6 plus negative 16 plus 14, you have a $4 million profit. And why? Why you have $4 million profit in total?
So your fixed price is 120 and your total cost is 116.
Awesome, good job, right? So at the end of, upon the completion, you know that the actual cost for the entire project is 116. The price is 120. So you have a $4 million profit, okay? So over the 3 years, the three numbers together has to be equal to 4, right? Do we have any questions here? Anyone, any questions?
All good here.
Good.
Good, thank you, appreciate it. Okay, so let's move on to do a problem. Okay, so let's talk about this loss, right? The loss. So at the end of the 2019, the total loss expected on the contract is what? At the end of 2019, you estimate the total cost is 130 million, the price is 120. What's the total loss expected on the contract at the end of 2019?
10 million.
Thank
10
you,
million.
10 million, right? 10 million. So income recognized in 2018 is 6 million. So in 2018, you recognize 6 million, right? So you need to recognize $16 million loss in 2019. And these two numbers together, right, will give you the $10 million, right? Because this $10 million is what you want, right? You want to be up to this point. In 2018, you already recognized 6. In 2019, you better recognized negative 16. So you get the $10 million loss, right? So what's the component of this 16? Okay, so the project has been completed 80%, right? At the end of the 2019, 80% has been completed. And the loss is 10 million. So 80% of 10 million, that's the 8 million. And in 2018, you recognize the revenue 6. You're going to reverse that, right? What are you talking about in 2018? This is a loss. How can you recognize the revenue? This project is a failure, is a loss. What you have done in 2018, the recognition of the $6 million revenue, that has to be reversed. Okay, so you reverse that 6 million. So you get $14 loss, right? $14 loss. And then you need another 2, right? You need another 2 to make it to be 16. So that 16 is the expected loss, the remaining 20%. So in 2020, there's another last 20% to be completed. And that 20% of the $10 million loss is 2 million. So that's the 2 million. So in total, the loss recognized in 2019, 16, it has 3 components: current loss, 80%, future loss, 20%. That gives you 10. And then you also need to reverse the profit recognized in 2018, 6. So that's your 16. Does this make sense?
Yes.
Awesome. Anyone else?
Yeah, I'm good. So I think your slide may have frozen on my screen.
Did it happen to anyone else? Can you see me moving or not?
Yes.
See you moving.
Yeah.
I can
Okay.
see
See you
you
move.
Okay.
like you moving, but your cursor or anything hasn't changed on my screen for
Oh, maybe I
that's
didn't
like
move it. Yeah. No,
But it's moving now.
yeah. Okay.
It's moving, yeah.
Okay. Good. So I move on. So let's make this journal entry. Right. This is a construction contract. So let's take a look. See if we understand the journal entry. Cost of sales. Okay. So in 2018. Okay. I recognize a revenue of 30, cost of sales 24. Where, which account do I debit? Don't get this wrong. We spend lots of time on this.
You debit CIP.
Debit CIP, right? Very good. So debit CIP 6, right? In 2019, the revenue is 66. The cost of sales is 80, right? So can I debit CIP now?
No.
I need to
No,
do credit,
no.
right?
Credits.
Yeah, you need to credit.
How much do I credit here for CIP?
14?
In
Yeah, 14 should be 14.
So in 2019, now I realized this is the onerous contract, right? So do I, for onerous contract, do I have profit? Do I have gross profit?
no.
No, but you recognize the 6 before, right? What are you gonna do here? You're gonna reverse this, right?
Yeah.
Because this is an onerous contract, you know this in 2019, right? So there's no profit. So, but in 2018, you recognize the 6. That's not right. So you're gonna reverse it, right? So you're gonna credit CIP for 6. Does that make sense? Right? Because this CIP is the gross profit, right? In 2018, you think it's a profitable contract. You recognize the 6. But in 2019, you know this is the non-profitable contract. So you should not recognize any profit, right? You have to reverse the debit balance 6. So you credit. By the way, this column is credit, right? This column is credit. So now I have 6 plus 66. That's 72, right? So I need another, this is 80. So I need another 8. Which account should I do? I need to credit another 8. Which account I should go?
I think expected loss on onerous contract.
Okay. We know that number is 2, right? Remember, we calculated that number. That number is 2. But I need 8. Where do you think I should go? So this is called provision. This is liability, right? Liability. So if you lose, too bad. That's your liability, right? You have to keep working on the contract. You lose money, that's on you, right? Does that make sense? So provision is a liability. Provision is the term under IFRS. So it's a type of liability, okay? Because it's an onerous contract, you are losing, you are at a loss position. So you are, this is a liability. So are you okay if I put, oops, I put 8 here. So now my total credit is 80 and my total debit is 80. Are you okay with this? Okay, and now expected loss, right? When you talk about loss, do you debit or credit? When there's a loss, do you debit or credit?
Debit.
Debit, right? So I'm going to debit 2. That's my expected future loss. And then I'm going to also recognize this as a liability, right? It's too bad, onerous contract. The loss position is on me, right? It's my liability. Okay, are we okay with this? With this entry in 2019? Okay, moving to 2020. So the revenue recognized is 24. The cost of sales is 12. Okay, that's good. So now I need additional debit, right? What do you think I should debit? So now it's a profitable contract, right? Do I have a liability? I have profit. In 2020, I realized this is not an onerous contract. So do I have liability now, or do I have profit?
Profits.
Profit, right? So let's first get rid of the liability. What do you what do you think I should do? So I have recognized this $8 liability, right? What should I do with this?
You debit.
Debit.
Okay, very good. So I debit this 8, right? So this will be canceled. So there's no liability, right? And I have 12 plus 8, 20. So I have a 4 profit, right? Go to CIP, right?
Yes.
What are we going to do with this entry? So this expected loss entry. And now there's no expected loss. What should I do with this entry?
You reverse the.
Reverse it. Very good. Reverse it, right? Okay. So in total, this is all canceled, right? So this is 120, your revenue. Your cost of sales is 116, and your gross profit is 4. Okay. Still have 8 minutes. Do we have any questions about this journal entry?
Oh, all good here.
Good. Awesome. Anyone? Anyone else? Yes? Okay.
Yeah, okay. Everything is okay.
I'm
Good.
good.
Good. All right.